In the next few minutes, I'm going to show you something that most people completely overlook. No hype, no headline, just the warning signs hiding in plain sight. Because right now, artificial intelligence is being treated as if its value can only move in one direction, up. Valuations are soaring. Confidence is excessive. And the most dangerous belief is spreading fast. As Sir John Templeton, legendary investor, said, the 4 most expensive words in investing are, "This time it's different." But history shows us an uncomfortable truth. When markets start pricing dreams instead of reality, risk doesn't disappear. It accumulates quietly. In the next few minutes, I'll share the critical warning signs with you that suggest the AI bubble may be much closer to bursting than most people realize. Don't be caught off guard. Michael Burry warns, is the biggest tech rally of our era built on a lie? The AI bubble is currently underway, comparing it to the dot-com and housing bubbles. Welcome to Finance Specs. If you're enjoying this video, make sure to subscribe to the channel. Now, let's break this down and understand what's really going on. In the late 1990s, global financial markets became increasingly dominated by a single narrative that appeared to promise a permanent break from economic history. The internet was not simply viewed as a productive technology, but as a force so revolutionary that it was assumed to render traditional valuation frameworks obsolete. Investors began to believe that profitability, cash flow, and balance sheet discipline were relics of an earlier era. Companies needed only to associate themselves with being online to attract capital, regardless of whether their business models were viable or their revenues sustainable. Equity prices rose not because firms demonstrated economic strength, but because investors extrapolated unlimited future growth from limited present information. This collective optimism produced a powerful feedback loop. Rising share prices reinforced confidence. Confidence attracted more capital, and additional capital drove prices even higher. As a result, markets increasingly priced companies based on imagined dominance rather than measurable performance. When the year 2000 arrived, this illusion collapsed abruptly. The Nasdaq lost nearly 80% of its value, erasing years of speculative gains in a matter of months. Individuals who believed they were participating in a historic wealth transfer instead found themselves confronting financial losses that fundamentally altered their economic trajectories. Many ordinary investors, drawn in near the peak, faced long-term debt and reduced financial security. Importantly, this collapse did not occur because the internet failed as a technology. On the contrary, the internet ultimately became one of the most productive innovations in modern economic history. The failure lay in the prices investors were willing to pay for uncertain future outcomes. Valuations had moved far ahead of reality, embedding assumptions that could not be justified by near-term earnings or realistic adoption rates. Markets corrected not because innovation disappeared, but because expectations finally encountered economic constraints. This episode illustrates a recurring principle of financial history. Transformative technologies can be real, while the prices paid for them can still be dangerously wrong. History rarely repeats itself in identical form, but it consistently reveals patterns in how markets respond to innovation, uncertainty, and human psychology. Periods of technological transformation tend to generate optimism that gradually evolves into overconfidence, especially when early success appears to confirm bold assumptions. In the present era, artificial intelligence occupies a similar psychological position to that once held by the internet. It is widely understood to be a genuine and powerful technology, capable of increasing productivity, reshaping industries, and altering competitive dynamics across the global economy. However, the recognition of its potential has once again encouraged markets to blur the distinction between long-term possibility and near-term economic reality. As capital flows aggressively toward companies labeled as leaders in artificial intelligence, valuation discipline has weakened. Many firms commanding extraordinary market capitalizations have yet to demonstrate consistent profitability, stable margins, or durable competitive advantages. Instead, prices increasingly reflect expectations of dominance far into the future. When markets price technology based on imagined outcomes rather than demonstrated cash flows, risk does not disappear. It accumulates quietly. This imbalance represents the earliest warning sign of speculative excess, even when the underlying innovation is legitimate. Throughout financial history, one phrase reliably emerges during such periods: "This time is different." It was repeated during the late 1990s, justified by the belief that the internet had permanently rewritten economic rules. It is repeated today with artificial intelligence, often supported by arguments that scale, data, and algorithms eliminate traditional constraints. Yet while technology evolves rapidly, human behavior remains remarkably stable. Investors continue to chase momentum, underestimate downside risk, and assume that exceptional trends will persist indefinitely. The consequences of this behavior become more pronounced when innovation intersects with geopolitical competition. Artificial intelligence is no longer treated solely as a commercial opportunity, but as a strategic asset tied to national power. Competition over advanced chips, data access, and skilled labor intensifies volatility rather than reducing it. In such environments, markets become increasingly sensitive to headlines and policy shifts. For the average investor, the greatest danger lies not in missing opportunity, but in mistaking optimism for certainty and entering markets at moments when risk is already elevated. For most participants in financial markets, losses do not occur because technology fails, but because behavior fails under pressure. The average investor tends to enter markets when confidence is highest, narratives are most persuasive, and prices already reflect widespread optimism. Conversely, fear dominates decision-making during downturns, leading many to exit positions precisely when long-term risk begins to decline. This cycle is not driven by a lack of intelligence, but by the psychological difficulty of separating short-term noise from long-term economic forces. Headlines move faster than fundamentals, and emotional responses often override disciplined analysis. Sustainable investment success has never depended on predicting exact turning points. It depends on understanding valuation, managing exposure, and accepting uncertainty as a permanent feature of markets. Diversification exists not to maximize returns in ideal conditions, but to preserve capital when assumptions prove wrong. Similarly, valuation awareness does not imply pessimism toward innovation. It reflects an understanding that even transformative technologies require time to generate stable and defensible earnings. When expectations accelerate faster than underlying productivity, the probability of disappointment rises regardless of how promising the technology may be. Artificial intelligence will almost certainly reshape labor markets, corporate structures, and economic output over the coming decades. Some companies will emerge as long-term leaders, capturing durable advantages and delivering substantial value. Many others, however, will fail to meet the expectations embedded in their prices. Markets do not reward participation in innovation alone. They reward patience, realism, and discipline. History does not provide a blueprint for the future, but it offers a reliable guide to how humans behave when opportunity appears limitless. That behavior has changed little across generations. Technologies evolve, narratives shift, and terminology updates, yet the underlying cycle of enthusiasm, excess, correction, and reflection remains intact. Investors who recognize this dynamic are not immune to risk, but they are far less likely to be destroyed by it.